Hello all. Welcome to the first episode of the MAFATA series. It sounds very bad, I know, but it is a short form for macro analysis, fundamental analysis, and technical analysis. I can't think of anything better lah. Okay, so since this is the pilot episode, I want to spend a little more time to go through the kind of content we will be covering in this series. For those who want to skip to the main meat of the video, you can fast forward using the timestamp below in the YouTube description. So the MAFATA series will be a short video series, usually about 10 to 15 minutes long. We will cover the current macroeconomic situation and some of the macro indicators that caught our attention. Of course, this will not be a very comprehensive macro analysis. If we do that right, the video will be like about 1 hour long lah. Okay, so we are not really going to do an end-to-end macro reading lah. Once we are done with the macro portion, we will pick out one of our trade ideas that Nimbus Capital have generated. We will share our views on the company fundamentals, the technical. So bear in mind that this is not a trade signal video. Some of the trade idea that we share, it may not be actionable at the time of the sharing. So you do have to do your own due diligence, and if the trade can be taken, and you have to ensure your own risk management. The purpose of this series is to walk you through the process by how we analyze the stocks. We hope that you guys will enjoy this series. Our goal is to make one episode every 2 weeks, and our target is 100 episodes. And once we have finished the 100 episode, we see whether if we want to continue this or not. So let's start with episode 1. Before we go through the trade idea itself, let's go through the overall market situation and the macro environment. So a quick glance at the S&P 500. We are 3 weeks into earnings. Bank and majority of the big tech earnings has been released. The S&P is looking to retest the 4,200 level. And if we look back at the larger time frame, S&P 500 kind of have been in a sideway without really any significant movement. We sort of started the year with rebound from 3,800 somewhere towards the end of December, starting of January 2023. We rebounded from 3,800 to 4,200. And towards middle of February, we fell back towards 3,800 once again. And then after mid of March, we rebounded back to 4,200 once again. So we are essentially in a kangaroo market. And seasonally speaking, April tend to be a bullish month. And then it is followed by the sell in May. So whether or not if there is selling in May is happening, we don't really know. We are not really that focused on the whole sell in May and go away either. We tend to see what is happening in the market and we decide from there. And also May is usually when all the tech earnings and bank earnings have been released. So we have a lot of decision making to do based on the kind of information that we are getting. Also to take note, most of the S&P gain was carried by Microsoft and Meta, and also a bit by Apple itself. Both Microsoft and Meta, both of which saw a huge rally during the earning. I think both rally about close to 10%. Meta went up as high as 15%. And for this week, we have Apple earning on Thursday post-market. So far for the big tech earnings, Google, Amazon, and Tesla earnings were pretty bad. Microsoft and Meta were doing fine. Not that great, but the earning itself was fine. So Apple will be the tiebreaker here. We do have 3 not so good earning, 2 quite okay earning. So Apple will either join the okay side or it will crash the market by joining the bad earning side. We don't really know yet. But regardless, Apple will be one of the biggest market mover that we will see in this coming week. And just prior to Apple's earning, we also have the FOMC. The May FOMC with the expectation of 25 basis point hike. and then a pause for the rest of the year. So this information, right, is already well known, and it is most likely priced in by the market. As per the previous FOMC meeting projection back in March 2023, we know that there will be no rate cut this year. However, a lot of development have actually took place during the March session and the upcoming session. For one, we have the Federal Reserve, the First Republic Bank blowing up. And now even JP Morgan is reluctant to buy out First Republic Bank. Okay. And we also have CPI inflation coming down to 5%. And the PCE inflation is now already at 4.2%. So in a way, we are kind of winning the inflation war. I don't really want to jinx it, but it does seems like we are winning the inflation war. But there are a lot of other systematic risks, such as the regional banks blowing up. So both of this situation, it actually sort of support the Federal Reserve cutting rate earlier. So whether or not if they will change their decision and cut rate earlier this year, right, it is something that we want to pay attention to during the FOMC press conference. So as usual, right, for the Patreon subscribers, we will have our usual live FOMC meeting at 2 a.m. in the morning. So if you are awake, if you cannot sleep, do hop on to a webinar and join this live session. And right after Apple's earning, before the market even opened, we have the NFP and the unemployment data, which is also another big market mover. So we actually have three big market mover that is back to back coming up in this week. So do be careful with your position. And one of the macro data that I want to highlight is the contraction of the M2 supply. So you can see here that the M2 supply, right, the contraction has been speeding up, and it doesn't seem like it is stopping. So should Federal Reserve maintain their decision on no rate cut this year, we may actually see liquidity drying up even more for the second half of 2023. And this is not usually great for equity market, especially for those companies who have very little positive cash flow and they have very high debt. They may run into issue due to the higher bank borrowing interest rate or the drying up of the liquidity itself. And on top of that, we also have the yield curve experiencing the steepest inversion that it has ever been. If you look at this green color line, the darkest green color line, it is the most recent yield curve, last updated on 28 April 2023. And if you compare it to the past 4 or 5 months yield curve, right, you can see that the back end of the current curve, it is at the lowest, but the front end of the curve is at its highest. So this is one of the most inverted yield curve that we have seen in quite some time. So it kind of indicates that the bond market is still expecting huge risk in the near term. So we don't really know what kind of risk are they expecting. I will assume it is the regional bank blowing up because we have the First Republic Bank. Even though the Federal Reserve rescue was to backstop some of these regional banks, right? We still have many more regional banks that are doing quite bad. I also want to point out the market breadth as well. It is something that we want to pay attention to because a lot of folks are looking at the S&P 500 market movement rallying lately, and there seems to be the idea that, okay, market is really bullish right now. So from price action wise, right, the index, the S&P 500 index, it does look bullish, but the breadth of the index is not really looking that healthy. And it is mainly because the rally was headed by Microsoft and Meta and Apple, some of the very few big market cap, big weightage company. And in fact, less than 50% of S&P 500 actually have positive year-over-year price change. So in terms of the overall market itself, right, we do see majority of the companies in the red. They are not really green. And usually in a bull market, the whole market is participating. You will have a very strong market breadth. And right now, things are not looking that way. So you may want to be a little bit careful on being overly bullish. So with all that said, Currently, for Nimbus Capital, we are managing a neutral portfolio. What do we mean by neutral portfolio? We have similar amount of long position and short position. For example, if we have 5 long position, we also have 5 short position. We don't trade index because the index itself, it doesn't really give us a lot of opportunity for profit. We select specific counters that are able to give us very high growth, or we short certain companies that are going to crash. And speaking of high growth, let's take a look at the company that we selected for this video, and that is Celsius Holding. So Celsius Holding is a consumer staple company that makes sports energy drink, as simple as that. So looking at the earning growth for Celsius, it is projected to grow by 100% in 2023 and then 60.95% in 2024. And the revenue growth projection is also tremendously strong. It is meant to grow about 54.59% in 2023 and then another 33.43% in 2024. So for a consumer staple company, this kind of growth is similar to high growth company like Tesla back in the heydays, where Tesla was seeing more than 100% revenue growth and sales growth. Okay, so if you look at the sector average, right, you can see that the Celsius Holding is actually way ahead of the sector average. Most of Celsius Holding competitors such as Coca-Cola, Monster Energy Drink, PepsiCo, or even Red Bull, right? The growth is not there. It is not that strong. So we are looking at a high growth company in a defensive sector, and this kind of combination is quite rare. Okay, so I think this company have extremely high potential for this year and next year. So now let's take a look at the income statement. Quite a few things stands out here. One thing I want to focus on is the past revenue growth itself. So you can actually see for 2021 and 2022, Celsius Holding is fully capable of making 100% revenue growth. In fact, for the previous year, they are able to make more than 100% revenue growth. Okay, so the growth is definitely there. It is very strong. However, if you look at the operating income for the year of 2022, the year that just went by, they make an operating loss of negative 157 million, and there's a total net income loss of negative 187 million. So in this case, right, what is actually contributing to the loss? Because if they make such a high sales growth, then they should be making equivalent amount of net income growth. But in this case, we are seeing a loss making for 2022. So in this case, right, if you look close enough, you can see that for operating expense, specifically the selling, general and admin expense, in 2022, Celsius Holding have a 426 million expenses, which is unusual compared to all the previous year. Because in the previous year, 2021, there's only 130 million expense. In 2022, the expenses were double digit in millions. So this 426 million for 2022 was, I would say, very, very unusual. And there's a reason for that expense. We will explain that later as we go through the slides. So the Q4 performance, the Q4 and the entire 2022 performance, you can see Celsius sales were up by 136%. And compared to other energy category, right, which grew about 17% for the entire year. And it is the third energy brand in convenience store. If we look at it at the data that was taken on 29th of January. And on Amazon, Celsius is actually the second largest energy drink at 16.9% share of energy drink category. And amazingly, it is ahead of Red Bull. Personally, I have heard of Red Bull, but only until now I heard of Celsius Holding now. So it is it is quite amazing. And the first is actually Monster Energy at the first with 26.4% market share. of the energy drink category lah. Okay, so Celsius Holding is very close second, is doing very well. If you want to compare Celsius Holding to Monster Energy, right? Monster Energy is a very large market cap company, whereas Celsius Holding is just a small cap company lah. So it is like comparing McDonald's, you compare to like Texas Chicken like that. It's like there's no comparison at all. But in this case here, right, even though there's a big difference in the market cap, the market share that Celsius have is a lot stronger. So now, this is the growth initiative. Celsius Holding actually have a partnership with PepsiCo. So this partnership, right, the transaction was closed on August 1st, 2022. So once the transaction is closed, right, they are trying to do a lot of growth initiative lah. So mainly, Celsius Holding is trying to make use of PepsiCo distribution channel. So since PepsiCo is a very established drink company, right, the fact that Celsius Holding is able to make use of PepsiCo distribution channel, meaning they will be able to reach higher number of customers, they'll be able to penetrate more household, and at the end of the day, the revenue growth will be extremely strong. And since the transaction was closed somewhere to the end of 2022, right, most of the benefit that is coming from this partnership, it will be visible this year. Hopefully in the first quarter earning of this year, we will start to see some of the growth visibility coming from this partnership. And due to this particular partnership, right, Celsius Holding have to actually terminate some of the contract that they have with other distributor. So due to that termination, Celsius Holding actually have to pay about 200 million in terms of termination, and that 200 million is actually showing up in the expenses that we saw earlier, the sales and marketing expense, which is what the distribution cost is under lah. So in 2022, let's take a look back at the transaction that we saw. In 2022, we saw the big $426 million expenses, but actually about 200 million of this is due to terminating contract for all the existing distributor, because now Celsius is partnering up with PepsiCo. So in this case, right, I would say that it is actually positive because it is a growth initiative. Celsius Holding will pay a short-term loss, a short-term damage in return, right? In the coming year, they will no longer have this huge expense, but they will also see a very big growth in their top line and the bottom line. And not only that, PepsiCo also made a $550 million investment in Celsius stocks lah. So it is kind of like, in a way, to put confidence in Celsius Holding, in sort of like letting them know that, hey, I know you guys have to pay the damage because you are partnering with us, but not to worry, we will be investing in $550 million with you in order to cover that damage. But not only that, you will be able to use that money to expand on your sales and marketing or whatever you want to expand now. So you can actually see here, cash proceed of $550 million will strengthen balance sheet position and fund ongoing initiatives. So we have a lot of positive stuff ongoing at the moment. And some of the negative stuff that we saw in the previous year, which is the loss making, is not really that negative because it is meant for further growth. Okay, so the $550 million that PepsiCo paid to Celsius Holding, it actually shows up in the cash flow. So you can see there's a $554 million that's coming in. So even though we have additional expenses on the income statement, right, there's actually a $545 million that is coming in from the cash flow activity. So with all that said, I would feel that there are two big growth factor for Celsius Holding this year. Number one, right, if the stock market is feeling negative about the loss that CELH Holding made in the previous year, I would say that that is not really a loss. That is more of like a short-term investment, short-term pain for future growth. And most of the benefit that CELH Holding is going to gain from the partnership with PepsiCo, right? It will start to be visible in this year. And if we see that big revenue growth and big sales growth coming in, on top of that, CELH Holding will no longer have that big expense on this year also, because that was a one-time expense. The $200 million, it is a one-time expense. So it will not show up in the income statement this year. That will probably lead to a very, very big earnings growth. It is going to become profitable again from a non-profitable state, with the revenue growth going up at an astronomical level. The idea is a long position, and we can actually see so far the trend for this chart is overall uptrend. But since the beginning of 2023, the chart has been coming down. And I will think that this price retracing very close back to the support level at $80, it is actually a good opportunity for any long position entry. If you feel long, if you feel strong on this counter, this retracement is actually quite a good opportunity for entry. And if we start to see all those growth materialize in the upcoming earnings, we will see a very big rally on CELH Holding. And in fact, the earnings is very, very soon. I believe it is in the month of May, but I'm not sure the exact day. Currently, CELH Holding have not announced the exact date yet, but it mentions that it is approximately around 14 or 15 May. So in terms of momentum wise, we are also seeing the MACD recovering towards the positive side above zero. The RSI is also improving, and we just bounced off from the support level, and the short-term downtrend line, this dotted downtrend line, is actually broken. So in terms of technical analysis, it does look good at the moment. On top of that, we have tremendous growth that is coming in, which I believe the market have mispriced. The market is not really pricing the growth properly. The market probably misread the loss as something bad, but actually the loss from 2022 is it is positive for CELH Holding. So in fact, this recent price action that we are seeing now, I will kind of take it as the market becoming a little smarter, the market realizing that, oh shit, why are we selling down this stock? I think this stock should see very big growth in the upcoming earnings. That's why it is turning back up. So that is our trade idea for this week. Whether you want to take up this trade or you want to take a look at how is it performing, please make sure you do your own due diligence on your risk management and portfolio management. Once again, Nimbus Capital, we manage a long-short portfolio management, and we are not really exposed to extreme risk from our individual trade. So I hope you enjoy this pilot episode. And if you do give our YouTube video channel a like and a subscribe, because it will allow us to get more viewers. And our intention with this video series is not just to share, but also to grow as a channel. Thank you very much, and I hope you look forward to the next video.